Well, Jason Pride is Director of Investment Strategy at Glenmede Financial. They run about $20 billion. That's a big number. He joins us now from the office in Philly. Hey, Jason, always great to see you. Thanks for coming on.
Thanks for having me on.
So I got to ask for your explanation here. Market down about 3% this week, and yet there wasn't really any disastrous or, frankly, really any bad news to speak of. So what's going on?
Look, I think it's a continuation of the same things that we keep dealing with, and it's going to be something that we're dealing with on an ongoing basis. The economy has been picking up, but picking up modestly. In contrast to that, we're seeing positive data coming out of the U.S. and maybe even some of the international PMI reports. But complete contrast to that is the political side of the equation as it relates to Europe. We have a fairly significant problem in Europe that is seeming to be, we're pushing in the right direction towards fiscal unity, but we're getting there very begrudgingly. The actual solution, the big picture solution, is going to take a long time to implement. And along the way, the ECB is only acting as a backstop. They're not doing what the Fed did in propping up and offsetting some of the austerity with overriding monetary policy. So we're going through a bumpy period here that's probably going to be extended for a considerable amount of time, even though the economic data seems to be surprising us a little bit.
Hey, what's the chance that you add all that up and it ends up dragging the U.S. growth down to where Europe's is, which is pretty flat? In other words, maybe even a recession. What's that chance?
We think that the U.S., we don't really agree with the idea of a complete decoupling between all these nations. I mean, the reality is we live in a very global environment. Trade goes back and forth fairly significantly between many of these nations, and then there's therefore a link. If Europe really declines, then that's going to be a problem. But having said that, our expectation is still that even with the austerity and everything that's going on, that it's more of a modest downside, likely a recession in Europe, but likely more in the 0.5% to 1% sort of range. Not something that will power through to the U.S. and really drag us into an abyss. And in the meantime, you look at the U.S. numbers. Employment has been kind of steadily inching up. You see some kind of firming in the housing numbers. The small business surveys seem to be kind of pointing in the right direction. They're not robust by any means, but it definitely looks better than it did in the middle of the late part of the summer.
Jason, let's do your shopping list here within that context. I get the high-quality dividend stocks. You're certainly not the first to recommend that. But here's the first time I've heard about chicken high yield. What is it exactly?
Sure. So our big theme is, look, if you're going through a slow growth environment and one that has a lot of extra risk, well, what you don't want to be doing is you don't want to be hiding in cash and treasuries, which are paying you nothing. But you also may not want to have just full tilt equities where you're taking on a lot of risk. And therefore, you come into the center of the risk spectrum. That means come in on equities towards high quality, but step up your risk perhaps in some of your fixed income, or consider a fixed income allocation like high yield to be an alternative to equities. Now, chicken high yield is double B or B rated bonds, only 2 notches below, 1 or 2 notches below investment grade. You get a very disproportionate yield pickup as you cross that investment grade to the first couple tranches of high yield. And therefore, we think you get a very disproportionate risk reward from investing in that space.
And how disproportionate is it?
Look, you can collect about 7% nominal yields in that area. It's relatively protected against inflation because you actually end up bumping up against call provisions in the bonds. And think about it in a growth environment where you're dealing with, say, 1.5 to 2.5% GDP growth. Corporations are probably going to have a hard time striking out and getting a growth rate that really beats that 7% yield on high yield bonds by a lot. And in the meantime, you're taking basically half the economic risk of investing in stocks by investing in high yield, high quality, high yield bonds, or chicken high yield, as we put it.
Jason, I know you don't like U.S. Treasuries, but it seems you do like some sovereign debt.
We do like some sovereign debt. I mean, the reality is that there are a number of nations out there that have lower net debt to GDP ratios. They're operating fiscal surpluses. It just happens that they're in the emerging economies and they end up being tied to commodities, so you end up taking some currency risk. But we think as a credit investment, when you're getting 5 to 8% yields on some of those sovereign bonds in those nations, that seems like a worthwhile trade-off to us compared to 2% on the 10-year Treasury.
Hey, Jason, let's move on to stocks now. Talk to us about some of these names that you like, Philip Morris International, Yum Brands, Colgate, et cetera. Kind of run through the case there on some of these names.
Right. So the overriding theme is high quality, stable companies, dividend payments, and dividend growth. The other underlying theme to all of those is an international attachment point towards that emerging consumer in many of the emerging nations. When those consumers are seeing their pay increase 10 to 20% per year because of government action or just companies paying their employees more, that's a good thing for consumer spending. So every single one of those ties to that. Colgate has a great international arm, both in Latin America and emerging Asia. Philip Morris International is heavily dedicated towards sales in emerging Asia, and Yum Brands is actually a fantastic proprietor of retail eating stores throughout Asia, particularly in China.
Yeah, well, they open a KFC, right? One in China every week.
And the interesting thing is, when you go to China and see the KFCs, they are nothing like what we think of them in the U.S. In the U.S., it's actually, I don't know, it's hard to actually look at it and think of it as a quality sort of operation. In China, it's actually it's a go-to location for that nation. They have a very different brand presence in emerging Asia.
Well, you are speaking to the choir when you are singing the joys of Kentucky Fried Chicken. All right, Jason, I appreciate your coming on. Have a great weekend. That's Jason Pride, Director of Investment Strategy at Glenmede Financial. All right, Lisa, fried chicken, I'm in.
Fine dining experience
let's order
here
some
in the U.S. All right.